For more flesh on those bones, we are joined by James Gerrish from Shaw and Partners and author of Market Matters. Hey there, James. Welcome to the program. ANZ, the first one to put its head above the parapet. What was your take?
Yeah, good morning to you. And it looks like a reasonable result coming out of ANZ this morning for their first half of 22. So their cash earnings came in slightly ahead of market expectations. The market was looking for about 2.9 billion. They did 3.1 billion. The dividend of 71 cents compared to 70 cents expected by the market. Net interest margins tracked a little bit lower, but that was in line with market expectations. And Tier 1 capital at 11.5% was slightly light on versus some expectations. So, and their commentary, of course, was pretty cautionary given the outlook for interest rates going forward. So, look, I'd sit back and say I think it's a pretty good result, and I think it'll be dealt with favourably on the market this morning, Annette.
How about that 72-cent dividend? Is that in line with expectations as well?
Yeah, slightly ahead in terms of the dividend. So the market, the consensus was at 70. I saw a couple of brokers at 71. So 72 will be taken pretty favourably in terms of ANZ. It also speaks to a level of confidence. As I said, Tier 1 capital 11.5%, although it was slightly below expectations, it's still very strong. So banks are very well capitalised. There's a recovery from an economic standpoint coming through, and that has filtered through into some pretty strong economic performance relative to what we've obviously seen in recent times.
Well, it's fair to say all the banks have probably hit peak reprovisioning, shall we say. So in terms of the forward guidance, economic conditions are very different. Is that bank speak for now we have inflation and rising interest rates?
Yeah, potentially. I mean, they've got to, you think about how the rhetoric that bank CEOs often give sort of speaks to, they're very well watched. The media scrutinises what they say very intently, so they can't be too optimistic about what they're seeing from their business point of view. They can say, yes, we've had a great half. We've had cash earnings over $3 billion. We're paying 72 cents out in dividends, but hold on, there's going to be tougher economic conditions ahead. So don't beat us up too much in terms of the earnings that we're making. At the end of the day, we want to, as Australians, we all want a strong banking sector. We want these institutions to be able to fund business growth. That we want them to be able to support the housing market and support consumers as they go through probably a tougher period in the next 6 to 12 months. That said, Shayne Elliott made a lot of commentary around how well the consumer is faring at the moment. Savings levels are high. People are very well ahead on their mortgage repayments, etc. So, look, I thought it was a good result, Annette.
And do you expect something similar from the others? I mean, Westpac's good at saying they're going to slash costs, but they never seem to get around to it.
Yeah, it's been the lagger. It's been the one that's been dealing with a lot of external pressures. I guess, from their own doing over the last couple of years, it's been an underperformer. Like ANZ has been an underperformer. So that if you think about the banking sector collectively, you've had NAB and CBA who have been the star performers in recent times. Westpac and ANZ have been relative underperformers. So when you get a situation like that, I wouldn't be surprised if we start to see some rotation out of the more defensive banks into the cheaper banks, which is out of CBA and NAB into ANZ and Westpac, obviously conditional upon how Westpac reports later in the week.
Well, in a couple of hours' time, we get March retail sales. Some talk about impact of floods, etc. But as you say, plenty of savings. Wages are on the rise. Even the RBA said that yesterday. How's the retail sector going to cope with these rate rises going forward? Are you more cautious on the sector?
Yeah, a little bit cautious on the retailing sector, but it comes down to what's baked into the market already. So if I think about one of the large retailers like Wesfarmers, for instance, fingers in a lot of pies, they've dropped from above $65. They're now trading below $50 a share. So obviously a lot has already been preempted into share prices in terms of interest rate hikes. It comes down to interest rate hikes are obviously the topic of the week, as they rightly should be. But the market is very aggressive in what they've already priced in. So if I look at the 3-year bond yield, it's moved from below 1% in January to now trading above 3%. You know, interest rate futures going out to September 23 are pricing a cash rate of 3.68%, which is huge. So I guess I sit back and think about what's been priced into the market. I think there's probably been a lot of negativity already priced into the retailers. Each retailer is different, of course, but as a sector, I think a lot of that negativity has probably already been priced in by equity investors.
Yeah, I think that's the tough one, is because the RBA keeps telling us they're only going to 2.5. The market's expecting 3.5. So net in the wash, that will actually be positive for equities if it turns out that rates aren't going as high as the market thinks.
Yeah, so I mean, if the RBA's neutral setting is 2.5, and that's what they're sort of guiding to. Economists think we'll peak out at 2%, so they're lower than the RBA's thinking. Some are even more more tepid on their interest rate expectations. UBS, for instance, think rates will top out at 1.6%. Then you have market pricing, so futures pricing at nearly 3.7. So there's a huge disconnect around where the market's priced, what the RBA is saying, and even more so with what economists are expecting. So it seems to me we're all just sitting there, putting our fingers up, and there's a lot of moving parts around this at the moment. I don't think anyone's got a clear understanding of where rates should be over the next 12 to 18 months.